Bloomberg on the Economy with Tom Keene. Wednesday, December 3rd, 2008.
James Grant, founder of Grant's Interest Rate Observer, Mr. Market miscalculates and miscalculates big. Deflation is so 1954. Will inflation be so 2011? Also, Grant on the value of Henry Singleton and hard money man George Walker. What a great book. You know, you see these compendium of previous essays, and they're usually like a yawner. It's like old news. Why is a Jim Grant essay from 1999 so fresh today? Why does this thing read so current?
Tom, you're asking the wrong guy. I mean, insofar as there is meaning in the ancient scribblings of a financial writer, it is that all of finance is cyclical, all of investing is cyclical. And the use of financial history is, I think, mostly to pound home the notion that nothing is ever exactly, literally new, and that what is past is, if not prologue, is at least instructive. So one can go back and, for example, look at the excesses of the Internet age, and at least to my mind, see a reflection, a pretty clear one, of the excesses of this moment. So I look at the phenomenal market cap of Cisco Systems and all the great hurrah that was surrounding the tech stocks at that age, and I look at, for example, U.S. Treasuries today yielding just about nothing, and I observe that value counts just as much for today in the government bond market as it did then in the tech stock market.
I mentioned 1954 in the intro. Jim Grant, you've got a great essay, Deflation a la Eisenhower, in Mr. Market Miscalculates. I thought that was must read because my line on Bloomberg surveillance and Bloomberg on the economy is this deflation is not my grandfather's deflation of 1954. Do you agree?
Correct. I think that to start with, one might define this word that is on everyone's lips now, deflation. So to me, deflation is not simply falling prices. A subsiding of the price level of the average of prices is a symptom. You know, you could have prices falling because of human progress. The world is more productive. Many millions of pairs of new hands at work in the world economy, and maybe prices ought to be falling just because we produce more with less. So that's one source potentially of falling prices. But deflation to me is prices declining on account of the collapse in a structure of debt. So if prices go down because everyone's going to get a margin call and corporations have to lay off hands and have to get rid of excess inventory because they can't service their debts, that is deflation. It's not progress.
Let me have you continue on where we are now with deflation and when it will flip to inflation.
It's a great question, and when is never my strong suit. To appreciate just how big the government's effort is at restoring the customary inflationary lilt to our affairs, you have to look at the balance sheet of our central bank, the Fed. And the Fed is, after all, a bank, and it produces a balance sheet every Thursday, dutifully.
$2 trillion.
Yeah, and you know, it was 900 or so billion, I guess a little more than that around Labor Day, and now it's over $2 trillion. So what that means is the Fed is creating credit by the boxcar full. That is to say, it's printing dollars, which dollars, of course, have no intrinsic value. They are pieces of paper sustained by the world's faith in the government that produces them. And to my surprise, the world has remained believers. The dollar is stronger, and our bond yields are lower, government bond yields lower than when we entered this crisis. So knock me over with a feather. I would have thought that people would say, this outfit, this United States of America, is not so creditworthy as it seemed. But the markets are all about paradox and certainly all about upset and surprise. And lo and behold, the world wants more dollars rather than fewer for now.
For now. When is the for now shift? I mean, that's a key Jim Grant analysis. Is the for now a 2009 idea, or have you extended out your timeline of the reversal to your call of inflation and higher interest rates?
So many birthdays have I had that I have not attached a date to the flip. One thing, you can go by to a degree. An investor doesn't always have to know when. He or she has to know rather the odds that you are being presented with by this manic depressive character, Mr. Market. So right now, to judge by the odds posted in the bond market and elsewhere, the world is pretty single-mindedly expectant about deflation. So, bond yields are hugging the ground. The Treasury's inflation-protected securities, so-called TIPS, you can look at their prices and infer that everyone's expecting no inflation for 10 years. So it follows that inflation-sensitive instruments, securities, options, and the like, are dirt cheap, and indeed they are. So, if you get the right security at the right price, you don't have to be so pinpoint in your timing, which for me is a very good thing. Not being a timing artist.
Jim Grant, 24 years doing this. 25, excuse me, and many years before that working in a combination of the media and the business. I'm looking at my Bloomberg screen, and folks, 0.01 4-week, 0.013 month, 2-year, 0.86, 10-year, 2.66, 30-year, a Jim Grant piece of paper, 3.19. I look at that, Jim Grant, and it suggests to me forms of instability within the economic system, and yet the dollar strengthens. When does this instability manifest itself?
Well, the instability, of course, is indeed out there and manifest now. These Treasury yields are a symptom not so much of confidence, I guess I'm now about to contradict myself, as of derangement. There is a general flight from what the market chooses to call risk into things that the market chooses to call safe. And the Wall Street Journal has a stock phrase, super safe treasuries, and it juxtaposes that with so-called toxic mortgages. A friend of mine has a racing stable, so accomplished an investor as he, and he names his horses after financial concepts. And one of them he calls overreaction. That is the way with markets. In 1984, with the memory of the 1970s inflation still vivid, people like those practicing this dark art today turned their backs on 14% long Treasury yields with a time when the inflation rate was 4%. They didn't want 14% yields because they recalled all too well the preceding 35-year bear market in Treasuries, that is, say, rising interest rates. And now they can't get enough of them at 3-something, with inflation at or above that on a backward glance. So, what are the predictive powers of the Treasury bond market? I'd say they are just about as potent as the predictive powers of a Treasury bond trader. So, like the rest of us, we don't know the future.
There's a political sense of you've got to get to a political statement on inflation. First off, is this new administration acting like what we saw in the 60s? Is the required Keynesian response now just going to be a redux of 60s inflation policy?
I think that is the effort under this administration, under the fading Bush administration. I dare say they're going to do more of the same. I think that what they will do is to spend and print as much as they have to do in order to get a response. And the response, I think, will not be wholly to anyone's liking within 6 months or a year. For the time being, these remedies are having no great effect. But I've watched the Fed for a long time, read about it since its inception. Never before has the Fed done what it's doing now. Never before. This is, to anyone who is familiar with the finances of our monetary affairs, I mean, this is unprecedentedly easy.
Should Mr. Bernanke be shown the door in a collegial way to let in a new chairman by the name perhaps of Summers?
No. I mean, here's my take on Mr. Bernanke. I think that back in 2002, 2003, he and his then chairman, Alan Greenspan, misdiagnosed the weakening price level at the time. They called that deflation. That was not deflation. That was, I think, a manifestation of productivity growth and of more things produced for less. So to fight that specter, they pressed interest rates to the floor and generated a great debt bubble. The destruction of that debt bubble has given them the deflation they feared 5 or 6 years ago. So that was yesteryear. Now what we have is a Fed chairman who is prepared to pull out every and all stops to reverse this. And if I had my druthers, I'd be on a gold standard. But notice that I have not been named as a likely successor.
I didn't see you up there with Tim Geithner and the others. Well, what number book is this, Jim?
6.
Sixth book, Mr. Market Miscalculates, and you opened it. I was such a joy to see this from a few years ago. Emulate Henry Singleton. Help us. Who was Dr. Singleton?
Oh, he was one of our great capitalists. He was the chairman of a conglomerate of yesteryear called Teledyne, and he was a formidable intellect fellow who read a book a day and played chess blindfolded if he chose to, and just to give his opponent a break. And he had this idea that a capitalist ought to commit his capital at opportune moments. For example, he would repurchase the shares of his conglomerate when they were down. This is a radical idea. And he would sell more when they were up. Now, we reversed that.
I'm shocked.